Ever wondered how India's monetary policies shape the economy and create opportunities for investors like you? What tools does the Reserve Bank of India use to ensure economic stability, and how does these measures impact markets, businesses and your investments? Financial expert Mr. Hariharan breaks down the strategies driving India's economic growth and how you can benefit from them. Let's dive in.
A monetary measure. So we'll quickly understand what are the monetary measures. Again, this is something that you and I keep hearing, seeing whenever RBI announces, certain decisions to the monetary policy meeting that they do. All right. So how do they do that? We look at some of these elements. They use some of these monetary policy tools. We've got CRR, SLR, repo, reverse repo, and OMO. So I'll quickly touch upon all of these, just to sort of give some flavor to what is happening, as far as RBI is concerned. Because again, from an investor perspective, it is important to know what is happening at the economy level, what is RBI doing, and therefore what could be the impact of those, on money supply, on liquidity, and therefore on interest rates. CRR, SLR, repo. In fact, reverse repo is not used these days. We have something called SDF instead of reverse repo that's being used now. So let's begin with CRR. So CRR stands for cash reserve ratio. What is the meaning of this? So let's say that I go to a bank and I deposit 100 rupees with the bank. From this deposit of 100 rupees that I have made, RBI says that you should keep a portion of that in the form of cash, and that money has to be kept with RBI. All right. So today the CRR is, I think, 4%. What it means is out of 100 rupees that I deposit, 4 rupees will be kept by the bank with the RBI in the form of cash. So what remains with bank is only 96 rupees. Got it? So CRR is cash reserve ratio, money that is kept by banks with RBI in the form of cash. Obviously, if CRR increases, so today it's say 4%, tomorrow RBI makes it 4.5%. What it means that out of 100 rupees, earlier 4 rupees was kept aside by bank. Now it will give 4.5% or 4.5 rupees with RBI, which also means that the banks now have 50 paise less to lend. Earlier, they could have lent the 96 rupees. Now they can lend only 95.5. You and I can say that zero point 0.5 does not make too much of a difference, but look at it at an aggregate level across so many banks, and it runs into crores of liquidity. So that much less amount is available with banks to lend. And if money supply comes down, which is the amount of money left with banks to come down, to lend reduces, what will happen to interest rates? It will go up, right? So what happens? RBI looks at it like this. Inflation is high. I want to control inflation. What do I do? And let's assume that the inflation is happening because of higher demand, that you and I are purchasing more and more goods and services. A lot of people are demanding the same goods and services, so prices are going up, contributing to inflation. RBI says, let's bring this inflation down. Let's increase CRR from 4 to 4.5. Bank will have only 96 earlier to lend. It has now only 95.5 to lend. So less amount of money left with bank to lend. So obviously there are more people chasing the less amount of money. So interest rates goes up. So if interest rate goes up, your loans will go up. So if the loans go up, out of 100 people, 20 might say, let's not take the air conditioner this year. Let's buy it next year. So in a way, you are reducing the demand. So you are in a way bringing the inflation down. So that's how RBI uses it. The second is called SLR. SLR stands for statutory liquidity ratio. Key important words here. Statutory means compulsory. Liquidity means you have to keep it in asset classes which are liquid in nature, which you can easily convert it into cash. So again, I go to the bank, deposit 100 rupees with the bank. Out of the 100 rupees, the RBI says you have to keep some portion in the form of liquid assets. But you keep it with yourself. So the bank will keep that liquid asset with themselves. What are the liquid assets? Bank can keep it either in the form of cash, they can keep it in the form of gold, they can keep it in the form of government securities. We call them as G-Secs. Okay, so gold, cash, government bonds, but they will keep it with them. Okay, so let's say SLR today say 18.5%. So out of 100 rupees that I go and deposit with the bank, 18.5 rupees will be kept by the bank with themselves. 4 rupees is already gone to CRR. So 4 plus 18.5, 22.5 rupees is out. Balance is 77.5, which the bank can lend now. Okay, so just as CRR, by increasing SLR, the amount of money left with the bank will reduce, and therefore they can control or tame inflation. So that's SLR. So again, when you look at monetary policy decisions, you will realize that RBI makes those announcements. We have increased CRR, decreased CRR, increased SLR, reduced SLR, so on and so forth. Right. The third one is called repo, REPO, and the full form of repo is repurchase obligation. Repurchase obligation. So what happens here? I am a bank. I need say 100 crores of money. So I go to RBI and I ask for 100 crores. RBI says I will lend you the money, but you keep a collateral, a security with me. So what happens is that the banks will go and keep a government bond worth 100 crores with the RBI. Okay. And after the period of that loan is over, the bank will have to go back to RBI, repurchase that securities back from the RBI. That's why it's called repurchase. Obligation means compulsion. It has to compulsorily buy it back from RBI. And when it buys it back, it will have to pay that interest. That interest rate is called repo rate. So the definition of repo rate is the rate at which banks borrow money from RBI. The rate at which banks borrow money from RBI. And please note, these are transactions that happen on a very short-term basis. Typically, it happens for 1 day up to 14 days. So banks need money for 1 day to 14 days. They go to RBI and they will borrow under this repo window called repurchase obligation. Okay. So again, if the repo rate goes up, so today the repo rate in India is 6.5%. So please note 6.5% is per annum. So if bank is borrowing it for say 10 days, it has to pay 6.5 divided by 365, which is per day, multiplied by 10 days, and it will buy back that. Again, repo rate, if RBI increases repo rate, banks will have to borrow at a higher cost. Banks borrow it at a higher cost. They will lend it also at a higher cost. If the lending goes up, the interest rate goes up, EMIs will go up. So if interest rate goes up, you and I will not take loans. So we will cut down on our demand. That is also used by RBI to reduce the demand and control inflation. Opposite of that is called reverse repo, which means banks have excess money and they go and keep it with RBI. In the repo case, banks did not have too much of money, therefore they went and borrowed money from RBI. In reverse repo, is opposite. Banks have excess money. What do? There are not many people taking loans. So our bank says, let me go and keep this money with RBI. It's a safe place to keep. And RBI pays interest on that. Okay, that's called reverse repo rate. As I said, RBI has done away with reverse repo. Today it's called Standing Deposit Facility, SDF. Okay, SDF. All right. So today SDF is at 6.25%. So if banks go and keep the money with RBI, RBI pays them an interest of 6.25%. So again, by using the SDF window, RBI can control the money supply. Right? So how will they do that? If they want to suck out the money from the bank, they will increase the SDF rate. So banks feel that it is more attractive. The RBI is giving me higher interest rate. Let me go and keep the money with RBI instead of lending it. So if they don't lend too much money, money supply becomes lower, interest rates will go up, and again they will cut down on the demand and therefore the inflation. So SDF is standing deposit facility, which is opposite of repo transaction. So in the repo, banks don't have money to go to RBI to borrow money. In SDF, banks have excess money. So bank has a lot of money and a lot of people are not taking loans. So bank will make money only when they give loans, right? But there are not too many takers for loans. So bank is left with a lot of excess money with them. What do they do with that money? So they go and keep this money with RBI, and RBI pays them an interest for keeping this money. That interest rate is called the SDF rate, which is currently 6.25%. So you will find that there's a difference of 0.25% between repo and SDF rate. It will always be lower than the repo rate. So that's the SDF window. The fifth one is called OMO. And this is something again which RBI keeps doing on a regular basis. So again, if you read articles, newspapers, especially business newspapers, you will keep finding this, statement or mentioning that RBI did an OMO yesterday, last week of 50,000 crores, so on and so forth. So what is this OMO? OMO stands for Open Market Operations. Okay, Open Market Operation. Definition is simple. In this OMO, RBI will buy or sell government bonds. Okay, RBI selling or buying government bonds, okay, is called OMO operation. Now, why do they do this? Again, to manage the liquidity. So if there is too much of liquidity, which means a lot of money in the banking system, it is not good. So RBI will try to remove that liquidity. They call it as sucking out the liquidity. So they will do an OMO operation to remove that liquidity. On the other hand, if there is shortage of money in the system, they will have to put money into the system, so they will again do an OMO operation. So by either selling or buying the government bonds, RBI will either put the money into the system or remove the money from the system. That operation or process is called OMO operation, which RBI keeps doing on a regular basis. In fact, every week they would typically do this OMO operations. All of these that we have discussed is to ensure that there is reasonably good amount of liquidity, adequate liquidity, and interest rate in the economy is also optimal. Now, from an investment perspective, from an individual perspective, if you're taking loan, you have got loans. Most of us these days take floating rate loans. So what happens in the floating rate loan? Typically, if and that is linked to your repo rate. So if RBI increases repo rate, you will find that your bank will also follow suit and they will also increase the interest rate on your loan. Okay, so your EMIs will go up. On the other hand, if RBI cuts the rate, repo rate, ideally banks should also follow suit and they will follow suit, but with some lag, and they will also cut your interest rates. Your EMIs will come down. But RBI has been trying to cut interest rates. So when we say RBI is trying to cut interest rate, they are trying to cut repo rate. And we have been sort of anticipating this for the last almost a year now, that RBI will start cutting rates, Fed will start cutting rates. Fed finally did the rate cut. And then we said now RBI will also do the rate cuts. And when we use these words, RBI will also do rate cuts. Essentially, RBI will cut the repo rate. Okay. Now, what will be the impact of all of these? We will understand at the end when we complete all the. So we only have GDP left now. And after GDP, we look at what is the impact of all of these on various asset classes.
Thanks for your detailed answer. If you have any doubts regarding this or any other financial decision, don't hesitate to book an appointment with our financial experts. The link to the appointment is given in the description below. And also, would you like to know more about finance and investment? Then we would recommend you to attend our live webinar. The link to the webinar is also given in the description below. The webinar is absolutely free. If you like this video, hit like. If you are new to our channel, please do subscribe. Thanks for watching.